What happens when the governments request their gold back? That still lies in our future. We haven't seen that yet. I mean, we've had over 4,800 currencies that do not exist anymore. So we have lots and lots of examples. And at the end of the day, central bankers will use gold to attempt to
And since it wasn't the Bank of England's gold, since they don't have a lot of their own gold, but they do have a lot of other sovereign gold, you need to have the physical metal in your possession. You don't own anything if you don't hold it. And if the government needs to take something from someone in order to make that happen, they will. And if it's in a retirement plan, or you just said that the LBMA and other private clubs shouldn't be in charge of the global gold market. How do central banks make money? Does anyone ever ask that? You said the spot market was a joke in January, and you indicated that the prediction was that there would be 3,500 to 4,000 gold by now. We're not quite there yet, but we're close. I mean, did you overlook something in your forecast, or is the paper market lying about how much the real metal is worth? Yes, it is. That's exactly right, Jeremy. The paper market is always the one, since that's where people trade. And since we last talked, look at how much of the physical market there is. In the US, it's mostly a digital market, a trading industry. It's been more of a tangible market in Europe. But look at how much of that physical market was sent back to the US, mostly by the Bank of England. I'm going to use the word repatriated, since I think that's what happened. And since it wasn't the Bank of England's gold, since they don't have a lot of their own gold, but they do have a lot of gold from other countries. People on Wall Street prefer to quote spot price as if it were the truth, but this discussion reveals how far off that number is from the truth. The London Bullion Market Association clears $30 to $40 billion in deals every day, yet most of that money never actually goes to gold. It's instead leveraged contracts that are based on trust. When repatriations from the Bank of England grow up, it means that sovereign states don't trust leaving their gold in vaults in other countries. That's a warning sign that institutions disregard, because it makes them think they have more money than they have. Investors should think about whether their portfolio is based on a paper promise or real collateral. Next, the conversation moves on to why sovereign demands could destroy trust in the market. What kind of gold did they send us? I think it was, although I could be incorrect, and I think it's a lot of that sovereign gold. What happens when the governments want their gold back? That is yet ahead of us. We haven't seen that yet, but I think it's going to happen. I could be wrong, but I think that will completely stop the market from being able to hide the truth. And yes, you can't buy anything for the price. I don't care what it is. I mean, do you really think that equities at nosebleed levels are a good way to figure out what's going on in the economy? No. So would those shortages show how much people trust the official gold market? That's right. That's right. If a number of governments ask for their gold back at the same time, we experienced a little taste of this in 2014 to 15 during the European sovereign debt crisis, when a lot of countries requested for their gold back. When Germany requested for it, the Federal Reserve of New York answered, okay, you can have it, but it will take us 6 or 7 years or something. This is the bomb that calms you down. If enough sovereigns want their gold back, the whole paper market structure could fall apart because it is too heavy. Keep in mind that it took 7 years for the New York Fed to send Germany back its gold in 2013. This made people wonder if the gold was really there. Now in 2023, when global debt is over $315 trillion, liquidity pressure is even severe. Stocks with record multiples don't show how much the economy is producing. They show how money is being distorted. Investors should keep an eye on not only market pricing, but also data on custody and delivery. That's where trust starts to break down. Next, we'll talk about why having personal custody is more important than having formal ownership. It didn't really take them that long. They got it back before that, yet they had to wait a long time. And I believe things are much worse now. That is in our future, but you need to have the real metal in your hands. If you don't have it, you don't own it. And if a government has to take anything away from someone in order to make that happen, they will. And if it's in a retirement plan or something like that where you're not holding it anyway, that's where most of it is in the US. You know, much of stuff isn't kept private. You're going to see that kind of blast. And yes, the truth will start to come out. It won't fully reach its basic value just yet. That's what occurs when people try to get their confidence back. It's funny, someone from the Bund Bank came on here and talked a little bit about bringing people back from Germany. They also reported that some of the gold they got back didn't match what they sent over there. I don't know if you read this story in the Financial Times, but I guess the guy's name is Shellman. It's not hysteria when she says if you don't hold it, you don't own it. It's history. The U.S. took private gold in 1933 under FDR, and modern retirement accounts might be an easy target in the next crisis. Germany's Bundesbank has confirmed that certain gold bars that were brought back to Germany didn't match the records, which suggests that the bars were swapped or rented. That makes people lose faith in custodianship completely. For regular investors, having the tangible item protects them not just from price manipulation but also from policy seizure. It's evident what the lesson is. Paper claims can go away, but a coin in your hand won't. Next, he questions the role of private clubs like the LBMA in managing trust. Over there, he's a gentleman. He just said that private clubs like the LBMA shouldn't be in charge of the world gold market because it's too vital. He says that they're like these secret groups that make regulations behind closed doors. Even if the central banks use these private structures, doesn't that make people less sure that gold is the best reserve asset? No, I don't think so. I mean, it doesn't matter to me since I know how much an ounce of gold is worth and how it works. If it didn't have that entire functionality, I would have to say yes, because there would be no other way to accurately determine the gold's value and its relevance in the market. And what I mean by that is that Wall Street doesn't talk about how gold and silver are used in every part of the world economy very much. So you have the most features, but you also have the most buyers. People often call the LBMA a club, but what that really implies is that people inside make the rules and don't tell anyone else about them. That concentration of power makes you wonder, if the price of gold is affected by unclear rules, how can it be the best reserve asset? But she brings up an important point. Gold's real use isn't just in vaults, it's in business. More than half of the silver that is needed today comes from electronics and solar power. Gold is utilized in a wide range of things, from medical gadgets to semiconductors. No committee can get rid of the demand that functionality produces. That's what makes real assets different from fake ones. Next, she links that function to why central banks go back to gold when fiat currencies collapse. That's one area when you look at trading contracts like we do here in the US. And you know, the exclusive clubs you're talking about, it's really about how people see things. That's what it is. And so there will be a rising, as there always is. Overall, we've had more than 48,100 currencies that are no longer in use. So we have a lot of examples, and in the end, central banks will try to get the public's trust back by using gold. That's when you'll really see gold start to move toward its true fundamental value, which is based on the amount of debt that's been created, because this is money. This is money that isn't backed by anything. This is good money. They're both cash. They're the other side of the coin. This is used in one area. This is utilized everywhere. So what will happen in the end if people lose faith in not just dollars but in everything? All of them, right? Euros, yen, etc. The system of fiat money will lose people's trust, and the price of this, not the value but the visible price of this, will go down to its true underlying value. But this won't happen unless governments have to try to win back the trust of the people. History shows us that more than 4,800 currencies have collapsed, but gold has always come back. What stands out here is that central banks will eventually use gold as a weapon to rebuild trust if fiat money fails. Today's worldwide debt is more than 330% of world GDP, which is much more than it was during the stagflation period of the 1970s, when gold last rose to fair value. The analogy of the two sides of the coin is important. Fiat is about transactions. Gold is based on trust. People who are waiting for that pivot should know that it's not about timing gold, but about understanding confidence cycles. Next, she talks about how central banks have been quietly buying gold for a long time. Yes, that's fascinating. And of course, even while the price of paper is going down, central banks, especially in the East, are still buying gold like they always have. This year they bought almost 1,000 tons for the second year in a row. But since we're talking about data, Lynette, I want to know more. I mean, do you think that countries and central banks are hiding or not reporting all this buying? Yes, that's right. I mean, if their job is to lie, do you really believe they'll tell the truth in this one area? You know, maybe it's more true since we can see them collecting worldwide central banks, which means they are getting more gold than they ever had in the last 3 years. We also have central banks like the Federal Reserve that are losing money. And I think this is the Federal Reserve's 4th year of losses. That's never happened before. That has never happened before. How do central banks make money? Does anyone ever ask that? Why aren't these flows completely clear if central banks are the biggest consumers of gold in contemporary history? The World Gold Council said that central banks bought more than 1,037 tons of gold in 2023 alone. But other people say that China and other countries don't report their holdings accurately. The Fed is also losing money for the 4th year in a row, which hasn't happened since 2020. Losses plus a disguised purchasing signal are at the heart of monetary policy's credibility problem. If the institutions that make money are likewise hoarding gold, investors should ask themselves what that means. Next, she talks about how central banks make money and why it's not working right now. And it's not that hard really. It's senior, isn't it? It costs, well, this is a $10 bill. But if you have a $100 bill, here's one. It costs 9.4 cents to print a $100 note, but pushing a button to make one costs less. You and I have to work 100 times harder for this, yet the difference between the cost of making that money and its face value is what the central bank makes. That's what they use to pay for their work, and anything they don't use in a year goes to the Treasury. And now, for the 4th year in a row, the Federal Reserve has lost a lot of money and can't send any of it to the Treasury. Check out how much fresh money they've made. Why are they losing money? The big, enormous question. What do you think? It's the money they lost on all that debt they acquired at ZERP. But that's a little alarming, especially when this whole thing is getting bigger and bigger and more debt is piling up. And the companies that are now making these stable currencies are buying this debt. Why is the Fed losing money if it costs less than 15 cents to issue $100? The solution is trillions of dollars in low-yield bonds that were bought when interest rates were at zero. As rates went up, the value of those assets went down, locking in paper losses. That's why the Fed hasn't sent earnings to the Treasury in 4 years. In the 2010s, this was a source of money that brought in an average of $90 billion a year. If corporate stablecoins hold government debt, the risks get worse if forced selling starts. Investors need to know that even central banks may mess up their balance sheets. Next, she brings up the difficult truth that these losses are hidden by accounting methods. What happens when they need to sell it? These are not things that exist just to help these markets. Can they merely make up a deferred asset and put its losses off till later? Isn't that what it means to just kick the can? That's sort of what they do. But the point is that they have made more money than they ever had before. Their revenue comes from the cost of that money and the amount of money they have. How are they losing money? It doesn't matter to me where they placed it in their books. I'm only stating that I don't hear anyone criticize this. No one has asked me about it. I haven't listened to everyone in the world, but have you? No, no. The Fed makes a deferred asset to cover such losses. That's not new. It's a way to hide the money. In simple terms, this means they owe themselves money in the future, which is something no private corporation could do. Me Too supply grew by almost 40% from 2020 to 2022, even though the country made more base money than ever before. The Fed is still reporting losses in its operations. That contradiction should set off alarms, but the media isn't covering it much, so investors can't see the fractures in the system. People who don't trust gold will care if trust goes down here. It's everyone having bucks.